Imagine waking up one day to find the global economy on the edge of collapse. Governments, companies, and even households around the world are buried under trillions of dollars in debt. As interest rates rise and economies slow down, paying back that money becomes harder and harder. Experts warn that if this debt spiral continues, it could trigger a financial crisis bigger than anything we've seen in decades. In this video, we'll break down what the global debt crisis is, why it's so dangerous, and how it could potentially crash the entire world economy. Today, we will talk about the global debt crisis that could crash the economy. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding the global debt crisis. The global economy is currently facing one of the most serious financial challenges in modern history: an unprecedented surge in debt levels across governments, corporations, and households. Debt is not inherently harmful. In fact, it is a fundamental tool used by countries and businesses to finance development, build infrastructure, invest in innovation, and stabilize economies during recessions. However, when debt grows faster than economic output and becomes difficult to repay, it can create systemic risks that threaten financial stability. Over the past decade, global borrowing has skyrocketed to levels never seen before. International financial institutions such as the International Monetary Fund, IMF, and the Institute of International Finance, IIF, have repeatedly warned that the world's debt burden is reaching dangerous levels. If left unmanaged, this enormous accumulation of debt could trigger a chain reaction of defaults, financial market turmoil, and economic contraction that could potentially crash the global economy. Understanding the scale, causes, and consequences of the global debt crisis is essential to grasp why economists are increasingly concerned about the sustainability of the current financial system. 2. The massive scale of global debt. The scale of global debt today is staggering. According to international financial data, the world's total debt has climbed into the hundreds of trillions of dollars. Global debt reached more than $251 trillion, representing over 235% of global GDP, meaning the world owes more than 2 times the value of everything it produces in a year. Even more striking, other estimates suggest that global debt has continued rising to around $337 trillion in 2025. Reflecting an enormous increase in borrowing across both developed and developing economies. Over the past decade alone, global debt has increased by nearly 50%, jumping from approximately $213 trillion in 2015 to over $318 trillion by 2024, far outpacing economic growth during the same period. This means debt is accumulating faster than the world's ability to generate income to repay it. Governments account for a significant portion of this debt, with global public debt alone exceeding $102 trillion in recent years. Such numbers highlight the sheer magnitude of the problem and explain why economists increasingly refer to the current situation as a potential global debt crisis. 3. The major causes of rising global debt. Several major factors have contributed to the rapid growth of global debt over the past few decades. One of the most significant drivers has been government spending, especially during economic crises. During the 2008 global financial crisis and the COVID-19 pandemic, governments around the world borrowed trillions of dollars to support businesses, protect jobs, and stabilize financial markets. These emergency measures were necessary to prevent economic collapse, but they dramatically increased national debt levels. Low interest rates also played a major role. For years, central banks kept borrowing costs extremely low in order to stimulate economic growth. Cheap credit encouraged governments, corporations, and households to take on more loans. In addition, demographic pressures, military spending, infrastructure projects, and social welfare programs have further increased government borrowing. Corporations have also accumulated massive debts to finance expansion, mergers, and stock buybacks, while households have taken on mortgages, credit card debt, and student loans. Together, these forces have created a global financial system heavily dependent on borrowing and continuous economic growth to sustain itself. 4. Why excessive debt is dangerous. High levels of debt become dangerous when economies slow down or when borrowing costs rise. Debt must eventually be repaid with interest, and if governments or businesses cannot generate enough income to meet their obligations, they may face default. Rising interest rates can quickly make debt more expensive to service, placing enormous pressure on borrowers. In recent years, many central banks have increased interest rates in order to combat inflation. While this helps control rising prices, it also increases the cost of servicing debt worldwide. Countries that previously borrowed at extremely low interest rates now face much higher repayment costs. For heavily indebted governments, this means a larger portion of national budgets must go toward paying interest rather than funding essential services such as healthcare, education, and infrastructure. In fact, billions of people now live in countries where governments spend more on debt payments than on public services like health or education. When this imbalance grows too severe, it can lead to fiscal crisis, economic stagnation, and political instability. 5. The impact on developing countries. While the global debt crisis affects all economies, developing nations are particularly vulnerable. Many low-income countries borrow heavily from international lenders in order to finance development projects, infrastructure, and social programs. However, these nations often face higher interest rates and weaker economic growth compared to advanced economies. As a result, debt becomes much harder to repay. Over the past decade, developing countries' debt has grown at twice the pace of advanced economies. Many of these nations also rely heavily on foreign currency loans, meaning their debt becomes even more expensive when their local currencies weaken against major currencies like the US dollar. Additionally, economic shocks such as commodity price fluctuations, natural disasters, or geopolitical conflicts can quickly destabilize fragile economies. 6. Historical lessons from past debt crises. History shows that excessive debt can lead to severe economic consequences. One of the most famous examples is the Latin American debt crisis of the 1980s, when many countries were unable to repay large loans borrowed during previous decades. The crisis led to widespread defaults, economic stagnation, and a lost decade of growth across much of the region. Another major example occurred during the European sovereign debt crisis after 2008, when countries such as Greece faced massive debt burdens that nearly collapsed their financial systems. Governments were forced to implement harsh austerity measures, including spending cuts and tax increases, which caused economic recessions and widespread social unrest. 7. How a global debt crisis could crash the economy. If the global debt burden continues to grow unchecked, it could eventually trigger a major economic downturn. One potential scenario involves a wave of sovereign debt defaults, where multiple governments failed to meet their debt obligations. This would cause massive losses for banks, investors, and pension funds that hold government bonds. Financial institutions could face liquidity crises similar to those seen during the 2008 financial meltdown. Another possible trigger is a sudden spike in interest rates or inflation that dramatically increases borrowing costs worldwide. Highly indebted governments and corporations could struggle to refinance their loans, leading to bankruptcies and economic contraction. A large-scale debt crisis could also destabilize financial markets, causing stock market crashes, currency volatility, and declining investment. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment